Hey, what's up, guys? It's Wiser with budget trading. It's 2:25 a.m. Monday morning, February 3rd. I just wanted to make a quick video on earnings and options trading during earnings and answer the main question on why I tend to stay away from earnings plays. And to answer the question that a lot of people have been asking is, why is it that I buy a contract uh, a day before or a week before earnings and the stock went in the way to favor the contract, and I'm still down on money, or I didn't make what I was expecting to make off such a move. I'm gonna try to answer them questions quick, and yeah, let's just get to it. So keep in mind, I'm making this video Monday morning before the stock market has even opened. It's not even 4 o'clock over here. It's 2:26 in the morning. I tried to make this video twice. The audio didn't come out, so this is my third time, final time. If it don't come out, sorry, you guys don't get to see this. If you are seeing it, it's because it worked out. Okay, so let's just take a look at Google. Google dropped $21 Friday. What you're looking at now is Friday's close and the whole day of Friday. And you'll be starting here at 9:30 in the morning. And the close is right here, okay? This is aftermarket, this is pre-market. So when it says it went down $21, I don't count that as much. I count it from pre-market because the $21 is down is from the previous close. But pre-market was up to $14.69. So I take it more like a $35 drop in one day. Now, for those who are trading options, you know that if you have a call contract and the stock goes down, your call devalues. It depreciates, okay? If you have a put when the stock is going down, your call gains value. So if you paid $100, it'll probably go up to $200 or $300. That's just an example, okay? Now, what I keep saying about earnings and why I stay away is because of the contracts. The contracts are garbage. I'm sorry to say it like that, but they are. The contracts are so inflated that the money that you're paying for them is nowhere near what these contracts are normally charged at or what they're worth. But the prices that you're seeing is an inflation because of the risk. The risk, okay? Because the people selling these contracts take on bigger risks, knowing that if a company has a good earnings, it can pop up a certain percentage, or if it has bad earnings, it can drop a certain percentage. So the people selling calls are predicting that the stock is going to drop, because why would anybody sell you something that's going to benefit you? Understand that? So when you look at calls, it's because whoever's selling them, it could be the market maker or an individual, a retail trader, just like you and I. They predict the stock is going to go down. So they sell you the call. And the only reason you buy it is because you predict the stock is going to go up, okay? So the market is made of someone's buying and someone's selling. There's two different opinions, okay? Now, let's just take a look at Google's option market. Let's go to February 7th, and we're going to go to the calls. Okay, so since the stock dropped $35, 21 from the previous close, the puts went up in value, okay? See? Even the puts that aren't in the money went up in value. 80%, 79%, 87, 90%. See if we get 100. Yep, 102% in one day. That's the $13.95 put is now up for $23.65. So for $2,370, you can buy this contract. But I want you to see something. This contract the day before closed at $1,170. $1,170. You practically doubled your money. That's exactly what you did. If you bought that contract the night before for $1,100, you doubled your money, okay? Now that's common if you have a put for a stock that's coming down. But what is not common, this is the calls now. See how the calls are negative, 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 negative. Check this out. Now they start to go positive. When they're green, it's because they gained value. and the percentage is telling you how much percent in gains. What's the percentage in gains that this contract has went up? Now think about that. The stock dropped $35 and you have calls that are going up in value. Something's going on here. Earnings is going on here. This is what I mean by contracts are being inflated. These are garbage contracts, but they were inflated Friday while Google was dropping. Look at this, 80% gain, 90%, 140% for a 1580 call. The stock right now, Google stock is at $14.35, and the contract that's $145 away went up $140 Friday. Do you understand what I'm saying now with the inflation? And this is because there's more risk added onto it with earnings because of the big moves that come when a stock reports earnings, especially a company as huge and as big as Google and Amazon. Look at Amazon, went up $200 and something after market the other day. Thursday, right? You have to see that. Stop throwing your money away. You have to, I want you to understand this. It's not easy learning how to trade options, but it's easy to understand if you open your mind and want to understand it, okay? So let's look at the 1580 call, which is $145 away. Now they want $480 for this contract. The day before it closed at $200. So even though the stock went the opposite way, and these contracts should have literally went to fucking zero. Sorry for the profanity. It didn't. It went up in value. But I'm going to show you why. Okay? Look at the bid and the ask. I'm going to do it here because it's highlighted in green. Look where it says limit price. The bid is $3.30, which is equal to $330. And the ask is $6.30, which is equal to $630. The bid is what the highest buyer is willing to pay. So from all the buyers, the highest bid right now is 3. That means that the highest bid is what you see here. It's easy. He's saying I'll pay $330 to buy this contract, but the one after him probably wants to pay $250 or $290. So what I mean by the highest bid is what you're looking at here, and the ask is what's the lowest number the seller is willing to sell it for, and it's $630, which means the next seller probably wants $700 for the contract. But that difference between the $330 and the $630 is what you're seeing across where it says $4.80. So when you see the $4.80, which equals to $480, I don't want you to think that this is what the contract is worth. Because right now, if you bought that contract for $480 and the next buyer is only willing to pay $330 and you try to sell it, you could only sell it for $30. So you automatically lost $150 buying that contract from the gate. That's what you lost, because the contract that you have is only worth what someone is willing to pay for it, and you got stuck with it buying at $480 when the highest buyer only paying $330. I need you to understand that. And this is why when you buy contracts too close to earnings, and even though the stock moves the way in the contract, if you have a call that goes up, if it has a put it go down, and you didn't make any money, it's because you overpaid. You got into it when it was all being inflated like a fucking balloon. Sorry for the profanity again. Do you see that now? And I want you to carry this on with every contract that you buy. Always look at the bid and the ask. Always. Because that's going to tell you if the difference between the buyer and seller is so big that you want to stay away from that. When you see the gap closer, then you know it's enough buyers and sellers, enough value in there. But when you look at this, There's only one buyer and one seller. You understand? And you can carry this with you to any stock, to any contract. Stop overpaying. Stop overpaying for these contracts because you're giving your money away. You're just throwing it at the market. You're hand feeding the market because you lack the knowledge. And I'm trying to help you. Now, there's another side to this coin. Because yes, you just got to experience inflation. But now think to yourself, if you would have bought this contract a month ago, where it was a month away from earnings, where the inflation wasn't as big as it is the day of or the day before, because this is Friday's prices. Imagine you bought this contract, which was $145 away from the stock price, for $20 and held it on up to today. That means, let's just say you bought 5. That was $100 you put in. And today, well, this was Friday, the highest buyer would have paid $330, and you own 10 of them. You made $100 into $3,300. That's the other side of that coin. So this is why I say I don't play earnings, but I know how to play earnings. And I don't mean holding contracts to their report. I mean buying these contracts a month or 2 months out, knowing that Google can make $100 move either way. So let me just get anywhere in between that, or even a little bit further. It doesn't really matter, because when it gets closer to the stock, don't go too far out, especially on a company that's not a big mover. I'm using Google as an example because Google is a big mover. So these contracts that go further out, $100, $200, $300 away, are still priced similar, you know? But you're not going to go to GE or something like that and think that you're going to buy contracts $10, $20 away. No. Even though they all get inflated, but if you're paying $20, you would like to make maybe 2 or 3 times more, not just another $5 in 2 months. For that, you might as well just buy the stock. So you got to watch the contracts you're buying and the contracts for the stock that you're buying them. Okay? I hope that this opened a lot of eyes today. And yeah, I mean, you know what? There's a way to play things and there's a way not to do it. So I hope you were able to take that away. And it's 2:30 in the morning, so I'm going to bed. I just figured I could shoot this out there and hopefully you guys will see it. Because in these next few weeks, we're going to get a lot of companies reporting. Some of the bigger ones, the FANG stocks, just kind of reported behind us. And we got Google coming up now. We got Disney coming up. We got a few of them, man. So there's a way to play it and there's a way not to play it. And then again, you have the, you know, you have the luck. You can have luck on your side as well. You know, you can buy like I did the other day. I did that more on what I felt, even though the market doesn't care what you feel about anything. But there was a lot going for Amazon that, see, I've been around a few of Amazon earnings, and I just had that feeling that this time it was gonna pop off good. So that's why it worked out for me in its favor. But I didn't play Tesla. I didn't play anything before that. So just wanted to throw that out there. But any question, post them down below. I'm still working on the YouTube video, but in the meantime, I'm gonna pump a lot of these little videos out so you guys aren't missing this education. All right. And yeah, that's pretty much it. I also, this is gonna be my public account. I'm pretty sure I got like $1,000 in here. I'm gonna use this account for videos and just to show you guys the gains, the losses, the plays that I made, so we can be a little more connected and you guys can see what I'm doing, how I'm placing trades, how I'm opening and closing spreads and so on. So we got a lot of good things coming, man. Just stay tuned. I love you guys, and let's get it.